Paul Saunders, investment partner at RealVC, discussing investment criteria, RealVC's M5 model.
Thank you. Nice to see everybody here. My name is Paul Saunders. I'm an investment partner at RealVC. We're an early stage venture capital fund that really focuses on the pre-seed, seed and Series A stages of the investing life cycle. In terms of who we are, our managing partner is Matt Berryman. He's a well-known founder. He founded a business called Unlocked, took that from 0 to 20 million of ARR in 18 months, expanded into 7 countries, raised $70 million in capital, and 10 days before the IPO, got yanked from the Google Play Store. That continues to rumble through the courts. He's taken Google on, and hopefully in the next week or so we should find some of the outcomes of that. He's also the chairman of Mental Health Australia, so I think somebody who really does understand the founder journey. The other 2 investment partners, one is Martin Dalgleish. His operating background really stems, I guess, from when he was the managing director of the consumer division of Optus. He then went to work for the Packer family, sat on the boards of Foxtel, Fox Sports, Car Sales, Seek. I've probably forgotten some there. He's also currently on the board of the Michael Castle Group and also KPMG. He's also been an investment partner at Heal Partners, which is also under our stable of funds, and also on Morpheus Ventures, which he just stepped down off, which is a US Series A technology and disruption fund. My own background, I've spent 30 years plus being a professional investor, I guess. First half of it in the listed side, so I started off as an analyst, became a fund manager, and then ran Goldman Sachs's hedge fund sales team in Tokyo for the best part of 10 years. Second half has been on the private equity side. I'm currently CEO of Asia Principal Capital, and the process that you'll see me describe is basically what we've been doing there for 15 years, and RealVC really is a putting of a much more robust balance sheet around something that we know to work. We also have 2 other venture partners. One is James Rushton. He's got 25 years experience operating. His last company was a business called DAZN, which is the world's largest sports streaming business. That went from 0 to 3.5 billion in about 5 to 6 years. And again, is somebody that really understands the media space and also how to scale businesses very rapidly. Final one is Hannah Spilver. You may have heard of her. She just recently sold her business, Lovely, very well credentialed founder. And she, as I say, sold her gifting business for $30 million plus earlier on this year. Why do we do what we do? Why are we interested in the seed stage? Our view is that the seed stage in venture capital is very underserved. Typically, it's lower check sizes, so your larger venture capital firms tend to put their more junior partners involved in this part of the market, which again, to me is ironic, given the fact the seed stage, when you've got probably 2 founders, small teams, limited skill set, is actually the most vulnerable time, which is exactly when the founders need the most help, the most experience, and the most, I guess, advice on how to avoid what are often existential pitfalls at that stage in the cycle. But the upshot of that is the seed business currently, or the seed stage in Australia, in our view, is fairly commoditized. It's spray and pray, write lots of checks, don't really get involved, and again, I think is more money than any other value add. Our view is active management, and again, I'm actually wearing a shirt and tie, or actually a shirt, sorry, for the first time in weeks. We are seriously sleeves rolled up active managers, and we believe that active management in this stage of the market drives very serious outsized returns. In terms of our investment thesis, and this is what we do, we invest early and we invest with conviction. Not interested in who else is on the cap table. In fact, frankly, I'd rather not have the clutter. We are pre-seed, seed, and a little bit of Series A, but it's really taking these businesses where we find exciting opportunities and really helping accelerate them. We're a team of founders. This is probably obvious from the original introductions. We're active, and we do something that we term assisted capital. And as I mentioned at my Asia Principal Capital, where I continue to be based, we have used this model very successfully for about the last 10 or 12 years. What is assisted capital? And we would expect half of our businesses or companies in our portfolio to be on this model, is where we get options. Sometimes it's from the ESOP, sometimes it's warrants, sometimes it's additional options that are really compensation for the serious amount of time and effort that we put into our businesses. And again, you can almost think of us as quasi-founders to the stage of how involved we get. Does it involve sitting on a board? Yeah. It also involves being phoned up at 10 to 12 on a Friday night saying, we've been hacked, what the hell do we do? So we do everything from board governance, act as CFOs, commercialization, networking, helping with overseas distribution. And as a consequence, we do get this additional optionality or exposure to our businesses. And you can really see the impact here. You have your original seed investment, which is where we're making our investments. But over time, as you move through the stages, A, B's, C's, the option component begins to get more and more value, and it really drives an outsized return for the dollars you put to work. So what do we avoid? It's often the best way to trade stuff. Firstly, high capital intensity. I like to refer to that as cash incinerators. Australia's a reasonably small market. We're not in the business of spending millions of dollars in terms of trying to buy customers. We're not in the business of huge amounts of hardware. So again, we try and avoid those as much as we can. Second thing is no science experiments. We're not clever enough to take on high amounts of science risk and also regulatory risk. And the third thing, wouldn't describe myself as an ESG zealot, but I certainly think that ESG is part and parcel of running a good commercial business, and we will avoid anything that has got negative social or environmental impact. So, where does that leave us in places that we want to play? First one, SaaS and software businesses. Love the gross margins. Spent the last 10 years investing in them. It's a great model to do here, light on capital and very easy businesses to scale internationally. Secondly, media. As you can tell with Matt at Unlocked, James with The Zone, Martin at PBL, we have a lot of in-depth industry expertise on the media space. PropTech, Martin and myself have done a lot of PropTech over the last 7 or 8 years, partly by accident, and then we sort of fell into it more and more. And a fun fact for you all, my COVID project was actually qualifying as a licensed real estate agent. So it probably shows a sad insight into my character. Health tech, we do a lot in the health tech space. One of our other funds that we are related to is a fund called Heal Partners, Health, Education and Lifestyle. Later stage, so it doesn't really cross over, but as a consequence of that, we see a huge amount of deal flow. Secondly, Matt, being chairman of Mental Health Australia, he acts as sort of a lightning rod for a lot of health deal flow. So we get more than our fair share, I guess, of health tech opportunities. Finally, positive secular trends. It wouldn't be tech if we weren't at the cutting edge of things that are changing the world. Our first deal, which was announced last month, I think it was, is in the gaming ad tech space, which has got huge positive secular dynamics. The second one is in the decarbonisation space. So again, I think it's not that we want to go and play in Web3 or crypto trading, but there are some very clear secular trends that I think it behooves us to really take a lot of time, interest and care in picking the eyes out of those opportunities. This, I think, was what Steve really wanted to talk about today, and it's our M5 investment model. Not hugely novel, and there are lots of variations of it around. Matt is based in Melbourne. Martin and I are based in Sydney. And when you have a distributed team, I think it really helps to have a sort of lingua franca, a common language by which to talk to each other and assess deal flow. And this is why we've sort of put into play the M5 model. The first element is by far the most important one, is management. That's the gating issue. There's no carbon copy for what the right founder looks like or the right management is. But I think if you had to put your finger on one clear skill that is probably the most important for any manager, and I could talk about this for hours, it's probably the ability to clearly articulate what their vision of the world is. Because if I look across here, and I'm a founder, I'm trying to convince you to give up your good job and come and work for me when I've got no revenue and an idea on the back of an envelope. An ability to inspire to hire is super important, and it also tends to show a lot more clarity of thought and an ability to execute. Lots of other things on the management side of things, but you kind of get the picture. If people have got through the management stage, Then the other four that we look at, the first one is market. We like big, expanding markets. Doesn't have to have an international component, but that's clearly really attractive too. Prove it out here. We know the playbook, for taking it overseas. So that is something that we really want. We will not play in shrinking markets. Life is hard enough building a business at scale to have secular dynamics going against you. It's horrible for pricing, tends to be horrible for capital efficiency, and it's something we avoid like the plague. Thirdly, model, and I'm sure there's been lots of talk today about the funding environment. We really want to be in businesses where we understand the unit economics of the business. Doesn't mean the business has to be profitable now, but I want to have a really good, clear pathway to profitability. Without that, a sort of black hole of cash incineration, horrible for capital efficiency, puts huge amounts of risk in businesses, and also dilutes investor returns as well. Fourthly, we have moat. A moat, I think, covers a lot of things. It covers product market fit. It covers your competition. It covers go-to-market. It might cover your IP. It might cover your patent portfolio. But it's really understanding that if we're going to be involved in a business for 4, 5, 6 years, really trying to understand who is going to be there to try and eat its lunch, and also why is that business going to have a sustainable advantage to ensure that we get the returns on the capital we put to work. Finally, we have moment, and I have to admit, it's really timing, but 4 M's and a T didn't sound very good, so we sort of moved it to moment. And it's really about, in venture, being early is almost as bad as being wrong. So what we want to understand is when we are putting money to work, why now? What is going to make this go from 0 to 1? And most importantly, because we're so active, what is it that we can do to change the dial? What are the doors that we can open? What is the capital that we can raise? What are the people and networks that we can bring into work in this business that can really drive that outcome and accelerate it? So the moment one is very important for us, and is often a gating issue. You look at great businesses and go, you know what? I can't add anything here. It's not our domain. Don't really know much. Don't have a network there. And as a consequence, we just say no to them. So that's our M5 model. And I think if you look at any investment any one of you have had that have gone wrong, and you think about it through that lens, you can normally pinpoint 1 or 2 of those that you didn't get right or you made assumptions about which didn't come to bear. Just about us, I guess. Why are we good at what we do? Experience is probably the best one. We've got about 120 years worth of experience out of the 5, the 3 investment partners and the 2 venture partners. We exhibit good judgment in general. And as they say, where does good judgment come from? Experience. And where does experience come from? Bad judgment. We have made just about every mistake there is to make in the book. And I think having that ability to pattern match and avoid the existential problems that you come across, monthly, daily, weekly when you're in startup land is super important in terms of being able to help those companies do well. Reputation and network, we've all been around a long time. We know lots of people. That really helps attract deal flow. It helps open doors. It helps DD stock companies. Really good if you've got an expert in a field and say, this looks really good, but do you mind taking a look at that for me? It's amazing how often that my best laid thesis gets shot down by a real domain expert as well. Deal flow, we see a huge amount of deal flow. I was just talking to a gentleman earlier. We were in the AFR 29th of September, August, I think it was, basically a month ago. On the back of that, we have seen 150 pitch decks have come across our desk in the last 5 weeks. So it might be a tough funding environment getting the dollars, but there's a huge amount of activity out there. And one of the things that doesn't worry me is the fact that we won't be able to find the right companies to back. Discipline, I think it's more and more of an issue now in light of how markets have moved over the last 12 to 24 months. There are a lot of funds sitting on a lot of very underwater investments. We have a very disciplined approach to entry. In a bull market, there's often the refrain that it doesn't matter what you pay as long as you get your seat on the rocket ship. In a world where there's not free money, getting discipline back in terms of your entry prices is really, really important. And I have to say, it probably just dates me. I've been around too long just to not care about what I'm paying for things. Again, I can talk to you offline if people are interested in how we do that. Finally, risk management. Interestingly enough, we sold a business for just under a couple $100 million earlier this year. And I think there are definitely 2, maybe 3 times in that 5 or 6 year journey when that company should have gone bust if it wasn't for the work that we put in. I do think the active management component of what we do does change the dial for your risk return profile. I think we take a lot of the or we can minimize a fair bit of the downside risk by being very active. And also, as I mentioned, the assisted capital piece does actually skew it on the upside too.